before we start. Just hear me out. Lay down certainty. Welcome down.
One day,
No true or false.
that all men are
No win or lose.
And I have accepted him as my Lord and Savior.
If you're feeling
I'm thinking I'm good for 100.
How much time I have left? You still have time.
the other way, assume the opposite. It might be true, and see what that reveals to you. Stay curious, I'll stay real. We'll slow it down, say what we feel.
passionate love.
And the future and the past present is
That looks like an investment proposal. Don't invest.
First they think you're crazy, then they fight you, and then all of a sudden you change the world.
End of the year, it should be about $150,000.
I want to point out the forecast has like almost always been wrong.
Don't know why it won't grind up to $1 million a coin over the next 4 to 8 years.
Hi, my name's Jagger. I have a big theory on everything, and I have opinions on everything else. That's why I write, and that's also why I decided to start this YouTube channel. So send me articles on anything that you think might be globally interesting. You can get me on X, you'll see it on the side. And so whether it's finance, economics, science, religion, philosophy, I'm going to be reading through part of a Financial Times article, which is entitled Strategy's Long Road to Nowhere. It's written by Craig Coburn. And stick around because I think the article makes some pretty good points. And I've opted to title this video, Why Strategy Has Not Failed. I don't think it's been a long road to nowhere, but it has been a frustrating journey. And so I'm going to touch on where it looks like failure, that addresses some relevant points around Bitcoin. It's called Where Money Goes to Die. And it particularly talks about Bitcoin being a belief. The success of strategy and of Bitcoin rely on the collective unconscious believing that money is changing, that Bitcoin is digital gold, and that it's continuing to increase in value year after year. Throughout history, the collective unconscious has believed in tales of gods, monsters, and other myths, including the battle between order and chaos, between sovereignty and control. Looking back, we probably struggle to understand things like the Greek gods, but keep in mind that some onlookers looking at us today might think the same thing about our beliefs, which include things like resurrecting the dead, virgin births, talking and flying animals, sea monsters or dragons, and some things that we might dismiss simply as miracles, but others might be skeptical of. If only a handful of people believed some of the things we believe, they'd be fringe lunatics, but because 4.5 billion people believe in Abrahamic religions, it's accepted. For Bitcoin treasury companies to take off, it relies also solely on belief. So I return to the idea that Bitcoin is a belief, and the success of strategy relies on the belief. Not only the belief in Bitcoin, but the belief in the concept of treasury companies. Obviously the belief in Michael Saylor, who's a controversial character, I'll give people that. And then his company being able to use a product or an asset that is increasing in capital value and is expected to increase in capital value at quite an astronomical figure, about 40%, through price discovery. And it doesn't actually have any cash flow, the normal way that we create yield in treasury companies. So let's see what the article says. Michael Saylor's strategy has spent the last 5 years buying Bitcoin. The company, formerly known as MicroStrategy, now holds nearly 713,000 tokens, funded with common stock, convertible debt, and preferred equity. Since the pivot to Bitcoin in August 2020, the stock has risen roughly tenfold. By any normal measure, that's a humongous success. Damn right, 10 times in 5 years is a humongous success. It's a compound annual growth of above 50%. But if you had purchased 100 shares in strategy, which was then MicroStrategy at the end of August 2020, just after they started buying Bitcoin, it would have cost you around $1,444 and would be worth just under 15,000 Rand today. So that is just over 10 times. Let's read on. Except that Bitcoin itself has been roughly break even. Strategy's average purchase price is around $76,000, which is close to today's market price. For all the sound and fury of Saylor's social media post, what he has done in aggregate is buy Bitcoin at prices that so far have basically lost money. So yeah, the writer is correct there. Strategy's acquired 713,000 Bitcoin, and the average price they paid is just over $76,000. Does this mean that they haven't executed on the strategy? Well, if they brought 713,000 more and had 1.4 million Bitcoin, the average price would still be $76,000. Tomorrow, the price of Bitcoin might be lower or it might be higher. It doesn't stop them from owning 713,000 or 1.4 million Bitcoin, whatever it is. The assumption is that despite 9 or 10 bearish months of Bitcoin, it will still on average deliver a yield of 40% per annum. That's really what Michael Saylor is betting on.
Bitcoin down. It doesn't stop. And this guy, Michael Saylor, had the audacity to come around with his smug fucking face every single time he wants to talk about his genius Ponzi. The guy's been flat on his investment. He suddenly discovered Bitcoin in 2020, and now he's just at break even. The greatest investor of all time. I mean, what are we talking about? Stop comparing this guy to Warren Buffett. If you're buying into this stupid fucking Ponzi, you're an idiot. I'll be back when I'm feeling a little more stable.
Firstly, let's acknowledge that no one can accurately predict the future price of anything. But if you consider the period that strategy have been accumulating Bitcoin, it's been increasing by a compound annual growth rate of approximately 41.5%, which isn't shabby, but it's not over 50% that strategy has been doing. The presumption that the company is underwater on its massive bet on Bitcoin is because Bitcoin is basically trading as the same as the average price. But I think this is flawed because in the last 13 months, since the 1st of January 2025, strategy have purchased more than 266,000 BTC. This is more than 37% of their total holdings. So with that in mind, let's carry on reading. For years, shares traded at 2 or even 3 times above the value of its Bitcoin. The large premium enabled the company to issue new shares, use the proceeds to buy more Bitcoin, and push prices higher. Each round reinforced the cycle. Higher Bitcoin prices widened the premium, making the next issuance even more accretive. The process became self-reinforcing. And so, we call this the flywheel effect or the Bitcoin accretion machine. And it relies on this feedback loop where, firstly, you need to sell your strategy shares, your MSTR, at a multiple that's higher than net asset value, because then it offers leverage exposure. And then because it trades at a premium, and sometimes the premium was 2 times or 3 times, as they said. So if you sell $1,000 worth of stock, it represents only $500, and you're using it to buy a Bitcoin. So that whole strategy makes sense. But when Bitcoin falls, as it has done since around October 2025, strategy share price can unwind as hard as it ran up. Let's carry on reading. So that is how the equity could have risen 10 times, even while the underlying Bitcoin position stands today with no mark-to-market gain. The Saylor premium did most of the work. This infinite money glitch seemed to hit a hitch in late 2024. The point that the author in the FT makes is that the very nature of the strategy flywheel is that it's pro-cyclical. It works most efficiently and most effectively when sentiment is already high. It creates almost a strategic paradox. You want to buy when the price is falling, but it's more difficult to raise capital then because the NAV is far narrower. When nobody wants to buy and the price has risen up quite high, although that isn't always true. Sometimes people do buy at the top. Normally that is when the NAV is wide and you want to actually create capital and raise capital. But who knows if strategy will ever trade on a MNAV of between 2 or 3 again. Right now, it's trading very close to 1. So strategy issued shares so aggressively that dilution started to erode the very premium that made the strategy viable. The stock peaked at $543 intraday in November 2024 and now trades below $150. Even though Bitcoin itself has declined by single-digit percentages in that time, indeed, over the last year, the stock has massively underperformed the asset it is supposed to beat, or at least track. The virtuous cycle has started to turn into a vicious cycle. So here the Financial Times has a price chart with a heading that strategy shares are underperforming Bitcoin by most measures. And again, I think this is true for shorter time frames because this is a 6-month price chart. But if you look at like the 3-year chart, then MicroStrategy or strategy had periods where it significantly outperformed Bitcoin. Even though the gap has narrowed now, it still outperforms Bitcoin. And the graph doesn't really show this so well. In fact, we know that strategy has performed nearly twice as well as Bitcoin. So the writer continues. None of this means strategy is about to collapse. There is no near-term risk of a run. The company has $8.2 billion in convertible debt, most of it currently out of the money, and so repayment rather than conversion is more likely given today's share price. The first maturity isn't until 2028 with a $1 billion investor put option in September 2027, meaning there's no immediate liquidity crunch. Strategy also holds a $2.2 billion cash reserve from recent equity raises, and preferred dividends can be suspended if needed. Saylor doesn't have to panic sell Bitcoin tomorrow. The company still has time. So I think this is the crucial point. As some people are posting nonsense that Strategy is about to go insolvent or liquidate, this simply isn't the case. The bigger issue is strategic. Strategy has launched 5 types of perpetual preferred equity, grandly marketed as digital credit, presumably to open new channels for funding further Bitcoin purchases. In practice, liquidity for these instruments has been thin and investor demand looks tepid. The stretched preferred dividend coupon has risen from 9% at IPO to 11.25% as the company tries to push it back towards par. These are expensive securities, and with the legacy software business generating no free cash flow, dividends can only be paid by issuing more Strategy securities or by selling Bitcoin at a loss. Yeah, it's the last point that gets investors a little jittery, I think, and had some calling Strategy a Ponzi scheme. But still, Saylor has committed to keeping the prefs at around par, or 100 cents, $1. And this is why they've been increasing the yield. Your post on X shows how 11.25% is significantly better than other products that rely on treasury yield to be passed on. And this is why it's so interesting that if Bitcoin treasury companies do work, they have no income tax implications at the moment, these distributions. It's a very interesting creature with such higher yields. And so let's notice what the writer says in conclusion. And this is the comment probably on why I've decided to do this video. It says, Strategy thus faces a dilemma familiar to existential thinkers. Jean-Paul Sartre famously said, "We are condemned to be free. Even when every option is bad, we still have to choose." Management is in that position now. Issue equity and you're diluting the common. Issue preferred stock or convertibles and you're subordinating common stockholders and saddling them with more obligations. Do nothing and the company slowly suffocates under the weight of its capital structure. There's no version of inaction that makes the common stock an appealing buy. What this seems to imply is that management are caught between a rock and a hard place with no safe choices, only different paths to destroying shareholder value. And so I think to a degree this is true if Bitcoin is in an extended bear market. But sometimes sitting on your hands and doing nothing is the best strategy, especially in current conditions. The point is made by the writer. He says, what all this exposes is that Strategy's model depends on 2 things, a rising Bitcoin price and continued access to capital markets. With cryptocurrencies weakening and the NAV premium evaporating, the market is calling into question both conditions. And so I guess the deeper problem is that the strategy was structurally biased toward buying when sentiment was strongest. Bitcoin was expensive and the premium was widest. It left little room to buy on the dip. Any approach that systematically pushes you to buy high and limits your ability to buy low risks running into trouble. You want to average down, not average up, when you're accumulating an asset. And so, yeah, Craig, I think you're right. The problem is that raising capital is easier when Bitcoin's going up. When you need to buy when Bitcoin's low. So maybe it isn't a bad thing that they're sitting on $2.4 billion in cash right now. They might not need to use it all for dividends. But the writer concludes by saying, it is hard to see the case for buying into a vehicle that is merely broken even on its investments over 5 years, whose capital structure subordinates common shareholders to layers of debt and preferred claims, and whose dividend costs can be sustained by issuing more stock or selling Bitcoin at a loss. I think what he's failing to note, though, is that they've got enough cash to meet 2 years of dividend demands. They haven't actually broken even with Bitcoin. If you're actually more precise, you can see that they've more than doubled in performance in terms of the share, if that's the measurement, against Bitcoin. And so for me, the strategies work so far. They're just in a bear market at the moment. But if you believe the US dollar will continue to devalue and that fiat is fraud, you will see that the future doesn't belong to the timid or the hesitant. Now is really the time to be buying MicroStrategy if you don't want to buy Bitcoin, or buy Bitcoin if you don't want to buy MicroStrategy. The book makes the point that it isn't always the smart money that wins, but usually the big money, the institutional money. And one of the issues that retail investors initially thought was a positive might in fact be a bit of a negative, and that is the fact that institutions have come into Bitcoin. JP Morgan, Vanguard, BlackRock, they all trading in Bitcoin. We've seen all these treasury companies, there's about 170 of them. They're not all going to survive. Unfortunately, these institutions have the ability to manipulate the price of Bitcoin, but they can also manipulate illiquid sovereign currencies. But being able to do something doesn't mean that they actually do it. And I don't think there's any evidence that they do. Keep in mind that blockchain is deregulated. It's not a registered financial market, but there is legislation that applies to Bitcoin. So technically, Market manipulation is still illegal, although it's not as easy to prevent or to police. Does it happen? Well, I don't know. There isn't evidence to say it does. However, what I can say is what we do know is that the best time to buy a strategy is when there is FUD, fear, uncertainty, and doubt, and when it trades below its NAV. And it's there now. However, Bitcoin works during periods of low yield, and Trump is playing a low yield game at the moment. What follows this phase of money being at a fairly low interest rate is likely to be a period of high yield, and high yield will see Bitcoin burst naturally, as people will probably have no option but to want to return to yield. I believe Bitcoin is an asset class. It's debatable, but like all asset classes, whether it's equities, bonds, or treasuries, property and cash, they all uncorrelated. They behave slightly differently depending on where we are in the inflation cycle, where we are in the interest rate cycle, and the business cycle. But what I'd like to do is I'd like to start by reading the first page of the prologue. It was Friday the 13th. The market didn't care much about superstition. It ignored individual traders, their hopes, their fears, their careful analysis. What it couldn't ignore was belief. When millions of people believe the same thing simultaneously, their conviction doesn't just move prices, it creates new realities. The market isn't driven by emotion or reason, it's driven by what we decide is true, and sometimes we decide together. For most of the decade, an almost reckless appetite for leveraged buyouts has gripped the market. The deals kept getting bigger, and the borrowed money cheaper, as financial institutions clamored over each other to lend. Traders were whispering that the Federal Reserve might nudge interest rates higher, which would tighten credit and possibly bring the debt-fueled party to a close. Then late on Thursday, after the closing bell, came the punchline. UAL Corp, parent company of United Airlines, had watched its proposed $6.85 billion leveraged buyout fall apart. On Friday, October the 13th, 1989, as the markets opened, investors panicked, and the Dow Jones Industrial Average said 6.9% almost immediately. To most, this was unfavorable, ominous even. But to 24-year-old Michael Jerry Saylor, it was the closest thing to vindication he'd experienced. Long before the crash, he'd been quietly warning the executives at chemical giant DuPont, the company he was working for, that the US economy was drifting toward a recession. His warning was based on the data, cold arithmetic, using his own analytics and understanding of systems. The market's sudden shudder seemed to prove to the executives that he hadn't been imagining things. And in the strange way that fortune sometimes rewards the inconveniently correct, the crash would end up opening a door for him. The date, October the 13th, would eventually link Saylor's story to someone else's. Someone who had not yet taken a breath, but whose life would in time intersect with Michael Saylor's. 4 days later, Saylor found himself in a boardroom in Wilmington, Delaware, sitting across from 3 DuPont executives, Morrison, Ibrahim, and Berger. Outside, the world was squinting at the aftermath of a sudden market wobble. Inside this boardroom, the world was about to change for Michael Saylor entirely. I won't read the full prologue. Let me read the epilogue now. And hopefully what is squeezed in between, I hope you'll find by going to Amazon and collecting the book. There is a certain elegance to a man who at 24 sat in a DuPont boardroom and convinced executives to fund his startup with no equity, simply because he was the only one in the room who understood the data. His MIT thesis, perhaps tellingly titled A Machiavellian Interpretation of Political Dynamics, wasn't just an academic exercise, it was a blueprint. Michael Saylor was a prime mover, a protagonist who believed that individual sovereignty meant making your own rules when the collective ones failed. His big Bitcoin bet is the ultimate iteration of this philosophy. Saylor saw the dollar melting, not as an abstract economic theory, but as a systemic failure. To Saylor, Bitcoin wasn't just an alternative currency. It was the first asset in history with perfect mathematical scarcity. Saylor wasn't speculating. Sure, it was a bit of a gamble, but not like buying Beanie Babies or meme stocks like GameStop is a gamble. His thesis was based on reality and probability. Saylor has turned MicroStrategy into a Bitcoin standard for corporate America, using debt and equity to accumulate 3% of the total supply and climbing. There are other Bitcoin treasury companies, but they won't all survive. We can never dismiss the role of belief in this story. Saylor understood, perhaps better than anyone, that money is ultimately a form of belief. Saylor has always been an opportunist. He danced in the chaos of market collapses. It was the 1989 mini-crash that opened the door to him starting MicroStrategy. He was opportunistic during the 2000 dot-com bubble, and he was caught in the middle of the game. When the SEC came for him, he didn't blink. He simply learned that perception is a variable you can manage until reality catches up. If a system will not let you change it, the only moral option is to game it. He believed that then, and he shows that he believes that now. Now, the smart money isn't looking at the panic. It's looking at the system builder, who is recreating the treasuries of the world. Saylor knows that volatility is just the price you pay for asymmetric upside. He sleeps fine because he isn't a trader. He's a holder of a new belief system. If you're waiting for the perfect moment, you've already missed the point. In the cold calculus of the Michael Saylor universe, the best time to be buying strategy and the belief that underpins it was yesterday. The second best time is right now. But I wanted to end on the note that this is probably the best time to be buying strategy. Firstly, it's clear that Donald Trump is following the same game plan as Richard Nixon did in 1971. He wants to move away from globalization to nationalization, and this is going to ultimately mean a weaker US dollar. And as a currency hedge, Bitcoin makes sense in a low interest rate environment. The reality is that if Trump can't keep inflation under control and he continues to pressure the Fed for lower interest rates, regardless of who the new governor might be, we know the rates won't be able to stay low forever. And Bitcoin, including strategy, might not survive an environment where there's a high yield on cash. It remains to be seen. So if you've enjoyed this video, like, subscribe, and please share. So thank you very much for watching.